This is Al Brooks, and this is my price action trading course. The current module is about scaling into trades. Scaling into a trade simply means adding to your current position and that you're confident that the trade will go your way soon, although you're not yet confident that the market has begun to go in the direction that you anticipate it will go. For example, let's say you're in a bull trend and the market has a pullback and there is a buy signal, and you take the buy signal, but you're not sure that the correction has fully ended, but you're willing to rely on a swing stop below the bottom of the bull spike, and the market goes your way for a bar or two and then drops below your entry price and drops below the low of your signal bar. Since your stop is below the bottom of the spike, probably several points below where you are now if you're trading in the E-mini, you're still holding long because you believe that your premise is correct, that the bull trend is intact. What you can do is, if there's another signal, for example, let's say it occurs at a lower price, you get another bull reversal bar, you can add to your position, and that is a form of scaling into a trend that is going against you. The pullback is a bear trend within a larger bull trend, and you're adding to a losing position, but you're confident that your original premise is correct, that the bull trend is intact. Another way to scale in is when a trend is already going your way. For example, if you're in a strong bear trend and you took partial profits and you're continuing to swing part of your trade, and the market pulls back and gives maybe a low 2 short signal, you can add to your position. You took profits on part of your trade, you still are holding part for a swing, and now you have a new signal. Perhaps you'll want to put your scalp position back on, and then when the bear resumes, you scalp out of the scalp part and you continue to swing on the swing portion. So when you added that scalp portion, you were already profitable on your swing portion, and you just were going for an additional scalp. And then if the market continues to fall and you get another sell signal, you're still holding your swing portion, and you can again put your scalp position back on. If you are going to do this, you have to keep the total dollars at risk the same as for all trades. So you need two things. You need to trade very small, and you need a wide stop. Scaling into a trade is not for beginners, and only traders who are consistently profitable should consider adding it to their trading methodology. Scaling in involves additional decisions, and trading is complicated enough without making it more complicated by scaling in, and it's something that I think most traders should not consider. Beginners need to keep their trade management simple. They should have simple rules and simple plans, and have as few decisions to make as possible, especially once they're in the trade. As an example, I'm going to talk about a pullback in a bull trend. There are many ways to scale in as the pullback continues to grow. One reasonable approach is, when you're thinking about entering, first determine where the swing stop should be. Let's say you normally use a swing stop, let's say you normally use a stop of 20 cents in the spider, and you determine that the swing stop is 40 cents from where you're thinking that you want to enter. So you see a buy setup, but the swing stop is 40 cents below. What you should do is trade a quarter size for your first entry. If you were not scaling in and your stop size is double, you would trade 1/2 size, because then if you get stopped out, you lose your normal maximum amount. On the other hand, here you're going to be willing to risk to that to that swing stop 40 cents away. If you trade half size and then add on lower, your risk is greater than normal. So you should start with a very small position, like a quarter of your normal position size. So if you normally trade, let's say, 400 spider shares, and you determine that your stop has to be twice what you normally use, you would trade 100 shares for your first entry, and then look to add another 100 as the market goes further against you, and exit the entire 200 at your swing stop, 40 cents from your first entry. If your premise is still valid and the market continues to fall, but it's still above your swing stop, you can buy that second quarter at a limit order at 50% down from the high. So you see where your stop has to be, which is probably the most recent high or low, and you see where the high of this current leg is. The market's pulling back from that. You can add a second quarter. In other words, if you normally buy 100 spiders, you would buy another 100 spiders at 50% down from the high, assuming again that your premise is still valid. An alternative to buying a 50% pullback is waiting to see if the market generates a second signal. If the market pulls back a little bit further, it may have a second signal, and then buy the second quarter position, the second 100 shares, as the second signal triggers. That second signal might be below your original entry. It might be at the same price as your original entry. It may even be a little bit higher than your second entry. In either case, you exit all if the swing stop is hit, the swing stop being 40 cents below your original entry. And you also exit everything if you feel that your premise is no longer valid. For example, if you bought believing it was a bull trend and now it's converting into a trading range, and you think it may even go below your swing stop but then turn up, don't wait for it to get down there. Once you believe that your original premise is no longer valid, get out. And you certainly need to get out if you see a convincing sell signal, especially one that is strong enough to convert the market to always in short. Here's an example of a market being always in long. We had a huge gap down and a very, very strong bull bar closing on its high tick, and a very strong entry bar closing on its high tick, and then another strong bar closing on its high tick. That would be a buy. We dipped below the low of this higher low, but basically formed a double bottom bull flag. So I think the market went always in long as it went above the first bar, and certainly by the close of the second. And this is more evidence that it's always in long. Another bull spike, another bull spike. So I think most traders believe that the market is always in long. The most recent higher low is this low. The most recent bull spike began with this bar. So if traders were swinging along at any point after we made this new high, they would make sure that their stop was below this swing low or below this bull bar. The initial stop when they bought above this bar was below its low. And then once we went above this lower high, we have a small higher low major trend reversal. Once we went above the new high, traders would raise their stop to below the most recent swing low or below the most recent bull spike. So traders could buy for any reason all through here. They can buy the low of this bar, they can buy the bear close, they could buy above the high of this bar. Doesn't matter. If a trader were buying a swing position, they would have to see how far away their protective stop is down here and make sure to trade a position size that would allow them to be comfortable losing that amount of money. On the other hand, a swing trader would look at that and say, okay, I'm going to take this long, but if it drops down here and gives me a second signal, I'll buy more. Maybe if it reaches a 50% pullback from this low to that high, I'll just buy more in a limit order and put my stop below here. If that's the case, they cannot trade half size. They probably should trade a quarter size. So buy a quarter size maybe above this bar, and then maybe another quarter size at their add-on position, and then a stop on the entire position below. If the market just goes their way right away, that's fine. They'll have a quarter size position, and they can add on higher as other signals develop. Okay, this is what took place. Let's say the person decided not to take this buy, 2-bar reversal, thinking the breakout was strong enough, maybe we'd have a second leg down. And then they have this small outside up bar, basically a small 2-bar reversal, 2 legs down. still always in long. The market did not flip to always in short here. This bear leg is not nearly as strong as the buying pressure that we've had today. So this is a reasonable buy. Okay, a trader could take it for a swing and put a stop below here, determine how many dollars they would lose if they were wrong, and then use the appropriate position size. On the other hand, a trader might say, you know, this may have more to go. It's a fairly tight channel. Maybe we'll come all the way down here and form a double bottom. I'm going to look to add on if we get a second signal. In that case, the trader would take a smaller position size. We're already halfway down. They can determine what position size they need if they were to add on. My guess is they probably would trade maybe a third of their normal size position, maybe a quarter, maybe a half, depending on how much they normally are willing to risk. So somewhere in their quarter to a half size position. And then if it goes their way, they manage it the way they would any other swing long in a bull trend day. If it drops lower and they add on, as long as the premise remains valid, as long as they still believe it's a bull trend, they can keep their stop down here and wait. And this is what happened. The market had a second signal down here. So a large two legs down. First leg here subdivided into two parts. There's a trend channel line here, not drawn. And then a small wedge bull flag. We went up and then down and up and down and up. Or you could simply call it a low two short. But I think not strong enough to flip the market to always in short. Almost here. We're starting to get a series of bear bars. But bear bar, doji, bear bar, small bear bar. I think the selling pressure is less than we had in the rally. So it could be a trading range day, or this simply could be a big pullback in a bull trend day. The bulls will stay long as it stays above the higher low, maybe above the high of the strong bull leg up. So anyway, at this point, the market developed another bull inside bar, closing near its high. I think that's a reasonable long for two legs down. Traders might say, well, Al, that's a lot of selling pressure here. Let's wait for a second signal. They could have, and they got it over here. But either way, either they bought here or they bought here. They could have waited and bought here. Okay. Here we have a double bottom, bull flag. It's bull trend, always in long, so it's a double bottom, and breakout right here, and then a pullback. So this is a breakout pullback from this large bull flag, a double bottom bull flag. You could also look at this and say, it went down for about 20 bars, so it's a bear trend. Remember, all bull flags are bear trends. They're just smaller than the bull trend that preceded them, and they're so small that traders believe that they're simply pullbacks within the bull trend. So here we have a bear trend. We have a bull breakout above the top of the bear channel. I did not draw the channel line in. And now we have a pullback to a double bottom with this low. So this is a double bottom major trend reversal for the bear trend that began here, the bear flag that began here. And we're still on the, I think, the always in long that began at bar 1. So traders could buy small here, add on here, or add on here or here, and manage the trade like a swing long. When an experienced trader sees a strong trend, he's always looking to add to his position. He can, in this particular example, we have an exceptionally strong trend. He can buy early for both a swing and a scalp, and then he can scalp out whenever his profit target is reached, hold his swing, rely on his swing stop, and then add on every time he sees a new buy setup. He can add on for a scalp or for a swing. On a trend day like this is a once a month type of trend day. It's exceptionally strong. We had a huge gap up, very, very strong, two first bars of the day, and the market just raced upward with very small pullbacks. So for the first couple of hours, it was a gap up bull trend, a trend from the open bull, a spike in channel, a small pullback bull. Eventually it transitioned into a trading range. It got exhausted. However, let's say a trader took his initial full position here and he put his swing stop below the low of his signal bar. He may have put his swing stop down below the low of the bull spike, which is the appropriate location. However, once the market had this big bull bar, the trader would have moved his stop up to below this low or below the low of the most recent big bar. Another bull breakout. So at this point, his stop probably would have been below here or maybe below here. At this point, 3 pushes up, 4 pushes up. Market's probably transitioning into a weak bull channel, a broader channel, or maybe even to a trading range. In any case, let's say that a trader bought here and then used his default, maybe taking half off at 2 times his initial risk. His initial risk below the signal bar and right here, let's say he used that for his initial risk, 2 times would be up here. So let's say he took his scalp off here and he still has his swing position on here. Maybe he scalped 2/3 or half and swung. Let's say he scalped half and is swinging half. Once he took his scalp off somewhere here and he saw another buy signal, he could put that half back on. So now he's back to a full position, and again he's going to scalp out. Maybe he'll scalp out at 20 cents in the spider. Maybe he'll scalp out at a measured move based on the height of this bar, which would have been somewhere around here. In any case, let's say he took profits around here, another buy signal, another high 1 buy. He could put his scalp back on again. And whether he took profits up here, he probably would have exited his scalp here. He would have kept his swing, maybe with the stop below either of these bars, maybe all the way down here. Another approach for really experienced traders with deep pockets, they buy their full position here and don't exit any until they see a reasonable sell setup. So they hold the entire position up here and then take half off here. What about these additional signals? The market is so strong they could buy more here, either another full position, so now they have a double position, or maybe a half, so now they have 1.5 of their normal position. If they did that, at this point, their stop would probably be here. So if the market comes down, they would have a small profit on their original position, and they would have a bigger loss on their second position. In general, I usually don't do that. Normally, I scalp out half at some logical target. When the market is this strong, I usually do not exit at 2 times a measured move based on the height of my signal bar. What I do instead is I use the height of the spike for my first target. So open of the first bar, close of the last bar, here a 2-bar spike, measured move up. So I would take half off somewhere in this area and swing the balance. So this is adding on to a bull trend at higher prices, and you can build a very large position. Some years ago I've tried, just full position, another full position, another full position, and I would have 3 times my normal size position. My stop would be at this point somewhere down here, so even if I get stopped out, I still have a profit. But to me, I start worrying about money, so it's beyond my comfort zone, so I no longer do that. Now I take half off at my logical profit-taking location, either 2 times my initial risk, or in this exceptional case, 2 times the height of this spike. And then I keep putting the scalp part back on. A similar approach can be used for a pullback in a bear trend. Again, one reasonable approach is to determine where the swing stop should be. So you have a bear trend, and the market is starting to bounce a little bit and starting to pull back, and you see what you think is a reasonable entry. And let's say it's an Apple, and you normally use a $2 stop in Apple. And here the stop has to be $4 away. And let's say you normally trade 400 shares of Apple. Instead of trading 400 shares and risking to $2, which is twice your normal risk, you would normally just trade 200 shares and risk to $4 if you were not scaling in. However, if you're going to scale in, remember you're going to add to your position, and that will increase your risk. So on your original position, trade a quarter size. So sell 1/4 of your position at the first signal. In other words, you sell 100 shares of Apple at the first signal. And if the trade goes your way, fine. Manage it the way you would manage a normal winning trade. If it continues to go against you, but you still believe the bear trend is intact, then add on. Again, relying on your original swing stop, which is probably the most recent lower high. You could sell the second quarter at a 50% pullback from the low, 50% of the height of the most recent leg. In other words, from the most recent lower high down to the bear low. Or you could simply wait until you see a second signal and then sell the second quarter on the second signal. And the second signal may be at a higher price. It may be at the same price. It may be at a lower price. In either case, you exit all if the swing stop is hit. You certainly exit all if the premise is no longer valid. So, for example, if you feel like the market has transitioned into a trading range or, in fact, has transitioned into a bull trend, you would exit all. Otherwise, you would continue to hold your entire position, which is 1/2 of your normal position size, until whatever profit objective has been reached. Here's an example of scaling into a bear trend. The market gapped up but then sold off and had 3 strong bear bars here. So it became always in short for most traders, certainly by this bar. For most traders, probably by this bar. There was a trading range, a breakout, and support down here at yesterday's close. Most traders would assume we're going down to test yesterday's close. And that maybe we'll get a trending trading range day, an upper trading range, a breakout, and maybe a lower trading range. Okay, to me, I think this is not a high probability short. If you take it, you may be taking a trade that has a 40 to 50% chance of success. You're taking it as a swing. Your stop is above the most recent lower high for a swing trade. So initially your stop is up here. And since it's not a highly probable trade, you're hoping to get a reward equal to twice your risk. So your risk is from the stop to your entry price, 1 tick below the signal bar. You entered right here. And then a measured move down to twice that distance, which is well below the bottom of the screen. You could convert the trade into a smaller profit based upon actual risk after entering. I talk about that in another module on actual risk. But for right now, let's assume you're going for a reward twice your risk because it's not a high probability trade. And let's say you take that short. You certainly were not happy by this close, right? You don't want it closing above the bottom of your signal bar with a big tail. Possible parabolic wedge. There's a slope across the bottom here and a steeper slope here, so it's parabolic, and it's 3 pushes down, so it's a wedge. It's possible that this is becoming the low of the day. But let's say, for argument's sake, you took the short and you're willing to sell higher, maybe on a 50% pullback with a stop up here. So if you normally trade 100 shares of the spider, maybe you shorted 100 here, planning on putting another 100 here on and exiting everything up here. But you'll also exit if your premise is no longer valid. At this point, with these 3 bull bars closing, 2 of them closing near their high, 2-bar reversal, strong breakout bar, 2-bar reversal with this bar or that bar or both. We did not quite get down to yesterday's close. We have tails on the bottoms of these 4 bars, and we have some buying pressure up here, decent bull bars and tails. The day at this point is probably back to always in long. So if you shorted here and your premise was that the market's in a bear trend and that you were going to scale in higher, maybe 50% pullback somewhere up in here, by the close of this bar, you'd have to conclude the market is always in long. So your original premise is wrong. You thought that you were in a bear trend, and now the market is always in long. So what do? Do you scale in and hope to get out, break even on the entire position, maybe exiting somewhere in the middle of your 2 prices? No, that's not what you do. You've now concluded that the market is always in long, and you're short. You can't do that. You have to get out immediately at the market. As soon as you decide that your premise is wrong and that it's now a bull trend and always in long and going higher, you have to get out at the market and take your loss. And it's as simple as that. This leg down, 3 consecutive bear bars is good. However, it's still within yesterday's range. Yesterday's range had a lot of reversals. We have many reversals going on here, and prominent tails and decent bull bodies. Certainly 3 good bull bodies here. So this is probably a bear leg within a trading range. It's possible that this is the low of the day, but a bear signal bar, that to me is not reliable. So I suspect that the day will be a trading range day. And this is how it ended up. This low one short became a 1-bar final flag. We had a parabolic sell climax, 1-bar final flag, and a reversal up, always in long. There was some follow-through buying, and there was even a second leg up. But ultimately, we went down to a new low in the day, and then reversed up again. That's what trading ranges do. They run above resistance. Remember, the swing stop for the bears was above this high, and the market went above it, only to turn back down. New low of the day, and then turn back up. And that's what trading ranges do. They run stops, they run below swing lows and reverse up. They go above swing highs and reverse down. You have to have a plan for adding on. How many times do you add on? At what intervals do you add on? What size do you add on? Do you do the same size every time, or do you trade larger positions on your subsequent entries? Okay, you can add on as the trade goes against you. You can add on as the trade goes in your direction. So for example, let's say you buy for a swing. The market goes your way. You take partial profits. It pulls back a little bit. You're still profitable, and you put back your original position. So you're adding on to your current position that is already profitable. Or let's say you're trying to pick the end of a pullback in a bull, and the market goes a little bit further against you. You're still confident that the bull trend will resume, and you add to your position at a lower price than your original trade. So you're currently holding a loss, and you're adding to a losing position. You can add on. There are different ways to do it. One is, let's say you're buying a pullback in a bull trend, and it triggers, and then the market falls below the low of your signal bar, and then forms another signal bar. So that's a second signal. You can buy there. Let's say it falls further, and you get a third signal. You can buy there. You can also add on at a fixed number of ticks. So for example, in the E-mini, you may buy, and then have a plan to buy more 1 point lower, and buy more 1 point lower again. What happens if you plan on scaling into a trade, and instead of the trade going against you, it immediately goes your way? You manage it like any other trade. And if you get your profit goal within the first few minutes, you just exit with your profit. When traders scale into trades, they can scale into reversals. For example, if they're bottom picking, they can buy. If it goes lower, they buy more. Or they can scale into trends. So if the market is falling and they're looking to short, they short, and goes against them some more, they short some more. Or they can scale into a trend that's going their way. If they short and the market continues to fall, they can short more at a lower price, building a larger position. Here's an example of scaling into a reversal. This is the daily chart, and there's increasing selling pressure. We have a strong bull trend, a reasonably strong bull trend, but now we're starting to get big bear bars. We have 4 big bear bars here, and we have 2 large bear bars here. So is the trend evolving into a trading range? I don't know, but it's certainly starting to accumulate a lot of selling pressure, and that increases the chances of the trend turning into a trading range and possibly into a bear trend. There was a strong break below the bull trend line, so traders will be thinking about the possibility of a major trend reversal when the market gets up to the prior high. Okay, so there's a bear signal bar, but we've had 7 consecutive bars without a pullback. So a bull microchannel and a bull trend, probably not a reliable sell setup. So most traders would not short below that bear bar, even though it's a double top major trend reversal. Here's that initial entry. Now, however, look what happened. We have a second strong bear bar at a slightly higher high. So this is a second entry short, and it's a second signal, and there's a strong signal bar. So this is a reasonable signal. It's a higher high, major trend reversal, and a second signal short. Traders might look at this and say, well, maybe we'll get one more push up, and then we'll reverse down. Maybe this will be the reversal. Some traders will simply put a buy stop above the high of their signal bar, and if they get stopped out, look for another signal. Other traders will say, well, I'm not convinced that this is the top. If it's not the top, it's pretty close. However, if it's not the top, and if the trend is going to continue, it probably will continue for at least a measured move up. So let me place my stop around a measured move up. So this would be slightly above a measured move up, below the bottom of the trading range, top of the trading range. Here's a measured move up. So this would be a reasonable location for a protective stop for a trader who's looking to scale in higher. However, if a trader shorted here and was using a stop way up here and was willing to scale in more here, their initial position would have to be very, very small, like maybe a quarter or a fifth of their usual position size. So if the trader took that short and then saw this, right, the market might be breaking out to the upside and might be resuming. It looks like we're evolving into a trading range. We have a lot of selling pressure here, and then more selling pressure here and here. If this is a trading range, most trading range breakouts will fail. This is an attempt to break out. So if the bears are right that this is a major trend reversal or a trading range, this breakout should fail. And these bears who shorted down here might rely on their initial stop up here and take a chance that this breakout will fail. Some traders would simply get out above this high, and if this reverses again, short again. And this is what happened. Here's that bull breakout, and next bar opened way down here. And then we had another push up to another high, a fourth high, 1, 2, 3, 4, a bear inside bar, a bear outside bar closing on its low. So we're getting another strong bear bar after reaching a new high. This would be a reasonable sell signal. So if the traders were willing to scale in higher and they shorted here, this would be a good location for them to short again. And by the close of this bar, they probably would place their stop on their entire position above the high of this bar. That would be two strong bear bars. This would be an extremely strong bear bar. The bears probably would not allow the market to get above the high of that bar. And this is what happened after that second entry, a very strong bear breakout bar. At this point, traders would tighten their stops to one tick above its high. And once the market had this strong bear spike, 4 consecutive bear bars down, they might start talking about moving their stop to break even. I probably would not. I would wait until after we've had one push up. So after we've had this push up and then a new low, I might put my stop at break even, maybe slightly above here. I don't think I would. I would probably keep it up there around break even. Double top bear flag. Bears would short again, either below this bear bar, that would be a good choice, maybe below that bear bar. And then a possible final flag here, a low too short, late in a bear trend, possible final flag, a bull reversal bar. This is a good location to take final profits. When you're scaling into a trend, when there is a strong spike, traders will trade in the direction of the trend, and many will enter on the close of bars. For example, scaling into a bear trend where there's a strong bear spike, traders will short, and they may short more on the close of every successive bear trend bar all the way down until the market reaches some support level. If you're selling closes in a bear trend, you can keep doing it until you're down to a support level, and then it's better to stop doing it. Here we had a gap up, a big pullback, and a channel. Possible new high of the day of a trading range day. And we've had 3 bear bars, and the bodies are starting to get bigger. So the market is probably always in short at this point, which means there probably are sellers above the high of this bar, maybe with a stop above the high of the day, maybe with a stop above the high of this bar. In any case, the market's always in short at this point, and traders will get short. So they'll start selling closes, and they'll also place limit orders to sell above the high of the bar. So let's say a trader sold the close of this bar. And then we have another bear bar closing. They could sell the close of this bar. They could sell the close of this bar. So they're adding to their shorts. Their stop at this point is probably above the top of this bear spike. We've had 5 consecutive bear bars, so that's a good enough bear spike. The market's always in short, probably since maybe this bar. Traders would not want the market to come back above the top of their spike. Now we have a stronger bear breakout, but we're getting close to the bottom of the channel. We had a spike up in a channel, and the market often finds support in the neighborhood of the channel. You can sell this close. I would be nervous that this could be an exhaustion gap, a sell vacuum down to the area of support. So if anything, I would be looking to take partial profits. Okay, so if you sell this close, I think you have to be willing to scale in higher, because this is a possible exhaustion bar, a sell vacuum down to support levels. Prior swing low, we found buyers over here, right? We found buyers here, and we're back to that general area again, testing the breakout point above this bar, also testing the open of the day again. So there are a lot of things going on here. Also, now we've had 6 consecutive bear bars, which is getting extreme, and traders will start looking to take profits. So if you sell this close, you have to be willing to scale in higher. There are many ways to do it. You could sell above the high of the prior bar. You could sell a fixed number of ticks up, like 2 points up, or you could sell a pullback, like maybe 50% retracement. With all trades, you don't want your risk to exceed your comfort level, so you have to make sure that the total risk for your combined position of all your trades is not too big. So you trade either very small or not at all. If you're not willing to keep your risk within your comfort zone, it's better not to be scaling in. So let's say a trader shorted this close, right? And they have to be willing to scale in. They're assuming that the market is always in short, so that there are sellers above, and they'll look for ways to sell. One is to sell above the high of the prior bar. So they might short, let's say they shorted above the high of this bar. Another is to sell about 50% of the retracement of the bear spike, so that's right around here. They might also sell below this bear reversal bar. Those are all reasonable ways to add to your initial position down here. Again, your initial stop is up here, so your position sizes have to be appropriate so that your actual risk is no bigger than on any other trade. Now, a lot of the traders who sold here and watched the market get up here, at this point decided that this was probably a bad place to go short. So they'll be happy if the market comes back here, and they'll get out break even on this short and take profits on those. So whenever you take a short in a situation like that and it turns out to be a bad short and you scale in higher, most traders try to get out around their original entry price. So they get out around break even on their first entry and they end up with a profit on their subsequent entries. So in this particular case, the market started to come down and traders would exit part or all of their shorts at this level. So they would get out of this short at break even, and depending on which short they took up here, they would end up with a profit on that short. If they saw these 2 strong bear bars and decided that we're probably going to get a leg 1 equals leg 2 move down, here's leg 1, here's the start of leg 2, they may have been willing to swing part of their trade. The screen is in a trading range. We're near the bottom of the range. We have a big tail, a pullback, possible 1 bar final flag, and a big tail. near the bottom of the range. Traders bought over here, and they bought over here, and we're in this price level again. We have about a leg 1 equals leg 2 measured move down. And you could argue that it's a large wedge bull flag, 3 pushes down, 1, 2, 3, or you can even argue the first push is here. So you can draw a trend channel line below. We had 2 attempts to break below the bear channel line, and we're reversing up. So lots of reasons why bears would take final profits in this area. That's the end of the module on scaling in.